Welcome to the Power Market Report. I'm Albert Liu. I'm joined today by Brien Lundin, publisher of Gold Newsletter and host of the New Orleans Investment Conference. Brien, thanks for joining me again on the Power Market Report. Crazy morning already. What do you make of this? Huge sell-off in U.S. stocks, trading halted after an 8% drop. We're still down. Where does it end?
Well, it does end at some point. It ends when fear transfers into greed, and at some point that is going to happen because what people will realize, first off, what's happening now is they're facing a very harsh reality and just now assimilating what this is going to do to the U.S. economy and what it's already doing to the global economy. And the implications of that, it's obviously going to be a recession, it's obviously going to be severe growth slowdown, et cetera. What is to come and the next step in this assimilation process is the markets appreciating the fact that the Fed is going to come in with massive amounts of liquidity, and then appreciating the fact of what that's going to do to the deficit and the debt, which was already exploding out of control, and those implications. And also the fact that this is a temporary phenomenon. And if they can look out, and they will begin very shortly, to say that this crisis has wiped out, say, 2 quarters of growth. But beyond that, there will be a very quick bounce back. So this is going to be something that right now investors have to hunker down. They have to weather the storm. And then at some point, there will be what I believe will be a kind of a V-shaped recovery as the markets are looking toward or begin to get greedy again and look toward the rebound, which I think will be fairly sharp as well.
A lot down in this sell-off. Gold, oil, Bitcoin, of course, down. Apart from cash, the 10-year was useful for a while, but it looks like perhaps liquidity concerns, people raising money, has caused problems for holders of even the 10-year Treasury. Where do you go besides cash, Brien?
I think you go to cash. Gold is, despite a lot of criticism it's getting for these sell-offs and these liquidity crunches, gold, in my view at least, is serving its role as a crisis hedge, as the last resort in an emergency. The mere fact that you can break open that piggy bank that gold represents and get cash when you need it is really its role. It's always liquid, and that's what it's there for. So I think from that standpoint, as a safe haven investment, it's serving its role, playing its role out very well. Looking forward, there will be an opportunity to profit from gold and, of course, the associated equities once the market gets past this and begins to appreciate what the remedial efforts from the central banks will be. Right now, though, everything's getting sold. Cash is the ultimate defense. Or gold, if you don't need cash, just holding gold and staying in it and weathering the storm is a good strategy as well, in my opinion.
I guess the point is that some people, or a lot of people, actually do need cash now because of the losses they've seen. Do you see the Fed coming in and stemming that? I mean, people are drawing on their credit lines, as people, meaning companies, are drawing on their credit lines more than they really need to, just planning for future liquidity.
Yeah, they are. They're drawing on credit lines just to get cash right now, and that will be a problem because there's only so much to go around, and banks are going to start, if they haven't already, excuse me, cutting back on those credit lines. So companies are sensing that and trying to get it while they can. So that'll stop pretty soon, and there will be cash crunches. I was saying as recently as for the last couple of years, that the next crisis or the next round of Fed easing would be much more than before and would involve fiscal measures. But over the last couple of weeks, as this coronavirus kind of erupted, that's one of the things I've really been seeing coming down the line is the fiscal end of this. And you can expect direct payouts from the government to American citizens at some point and at some level very soon. And you know, I think to get through this crisis, I'm not going to argue whether that's needed or not, or the moral hazards. What I am going to say is that the end result of all of this, the implications of this massive rush of liquidity, which will dwarf anything that we even saw post 2008, the implications of that are tremendous for the dollar, the value of the dollar, and for the relative value of gold and silver.
I hear exactly what you're saying, Brien. I think in terms of liquidity concerns for the banks and the companies that they serve, the Fed is equipped to help with that. And I think that's what they're doing. And now on the other side, though, they're not, right? They're not equipped to help out the person who has to stay home from work for 2 or 3 weeks. And that's where this fiscal stimulus comes in. I also agree that that's going to be, in the long run, extremely good for gold, especially if any of this stuff becomes permanent. Any of these provisions. I don't expect the tax holiday will become a permanent fixture, but maybe some of the other things they think of will. What are the chances, in your view, of that happening, of emergency provisions becoming permanent?
Well, they're certainly not going to ask for any of the money they hand out back. So that, in and of itself is going to be permanent. That's money that'll be created out of thin air. And you can expect the deficit this year, I would think, to at least double. It was already running about 1.2 to 1.5 trillion in the deficit, which implied a $2 trillion increase in the debt. And I think you can essentially double those estimates right now, just for this, emergency crisis as it is, not even thinking about the longer term programs that will be permanent. So yeah, there will be dramatic fiscal measures right now that are going to immediately elevate the debt and have long-term repercussions, and they won't go away. This money is being created, and every new dollar created lessens the value of every dollar out there.
Brien, you would think that the fact that this started in China, that they were the epicenter of this, they were caught off guard by it, that they would suffer the biggest economic hit. But I'm not sure if that's the case now, the way people are talking around here. In the end, who do you think is going to suffer the most from this? China, the EU, us?
It's really hard to say. It's not really a contest. I think the U.S. probably will suffer the least. The supply chain disruptions only now being appreciated, but China, because they're already past the peak in the bell curve, and are already starting their remedial efforts. They're starting their stimulus plans, et cetera. They just announced one, what was $500-something billion in direct stimulus programs. And that's going to be, obviously supportive of copper prices over the long term as well. So China may get out of this in, not good fashion, but perhaps better fashion than the other countries. At the very least, they're going to get through it more quickly. Of course, the issue there is they will get production capacity back, but if they don't have customers for that production capacity, they will also fall victim to the after effects that are being felt around the world. I think this is a kind of thing, and of course, I'm not a doctor, I'm not a epidemiologist, I'm not no real expert on it, but if we can get into May in the Western Hemisphere, the Northern Hemisphere, we're probably okay from the indications that we're seeing so far. That in the markets that we're concerned with, I think we're still going to have tremendous volatility for the next couple of weeks, a few weeks at least.
Brien, you make a good point. I guess the total damage to China can't be assessed until the demand shock part of the equation is in focus. And for that, they really need to know what's going on here, which is still to come. Let's talk about then investing and investment opportunities, Brien. I've been watching a lot of interviews, listening to a lot of people, and we're in bear market territory here on the indexes. We've been in bear market territory for a lot of these stocks for a while now, and it's surprising to me how, I guess, unenthusiastic people are about jumping in. Usually, when you get a pullback like this, there's someone that's willing to go out there and say, these are tremendous bargains.
Yeah.
I've heard some people say it, but not with a lot of conviction. And so it's surprising to me. Do you see any bargains out there?
Well, bargain, of course, is a relative term. If something gets cheaper tomorrow, it may be a bargain today, but it's not if it gets cheaper tomorrow. Yes, there are bargains out there. And if you look at it over the long term, if you look at in the junior mining sector, some of these companies that are absolutely on fire sale right now that are going to be drilling within weeks or a few months, and in the view or accepting the premise that things will be better at 3-4 months, maybe 5 or 6 down the road and normal again, then they're bargains in light of that. But again, if they're going to be cheaper tomorrow, then they're not bargains today. So I'm advising people to just sit back and not do anything for now. We're fortunate that we took some profits in some of our larger positions in Gold Newsletter over the past few weeks and months. So although we have been also fairly aggressive in buying some of these new juniors as gold has been responding over the last couple of months. So there seems to me little point in selling some of these juniors at current prices in a very liquid market. So it is a case of hunkering down and just waiting out the storm, in my view.
Brien, what is the outlook for companies that still have a lot of work to do and need to rely on capital markets that are sort of closed or closing at this point? What are the prospects for them?
They're just going to have to stop doing anything and cut back on expenses. It's not like they're not experienced with that, having gone through a 5-year bear market. But other than outstanding commitments, I think companies need to sit back and just wait this out. There's not a lot that they can't really put money or raise money in this market, so they don't have the funds in the bank. And even if they do have the funds in the bank, if they can curtail programs and wait this out, I think that would be a prudent course of action.
Okay, Brien, I'm going to let you go now. But before I do, I want to ask you just personally, how are you approaching this? Are you like me doing this interview while seated on a Peloton with your feet up on a pallet of toilet paper? Or are you going along business as usual?
Well, this is my kitchen, as you can tell, and not my office. It is probably the most scenic area in my house right now for a teleconference. I'm not too happy about the bar being in the background, but at least none of the glasses are missing and bottles open at this point. But yeah, I'm working remotely. I've actually made the decision this morning for the rest of my employees to work remotely for the next couple of weeks for a number of reasons. One being I'm not that confident in my building maintenance and keeping the elevator buttons disinfected. So it's just a safe, prudent thing to do. And I'm fortunate that our business is set up that everyone can work remotely. We have no walk-in business at all. So might as well be safe and prudent and work from home in the meantime.
Yeah, credit for that, Brien, and credit also for the bar in the back. We'd expect no less from the host of the New Orleans Investment Conference. So good work there.
Thank you. Once we sign off, I may have to crack open one of those bottles.
All right. Take care, Brien. Let's do this again.
Thanks, Albert. Appreciate it.